This can't be.
Everything seems fine on the surface. The stock market is buzzing and the big banks are assuring us they're safer than ever. But behind the curtain, something's breaking. A little-known company just collapsed, revealing billions in debt that was supposed to be rock solid. This isn't just about one company going under. It's the first tremor from a ticking time bomb that could be as big as $3 trillion, an unregulated shadow market that banks have been quietly feeding. And here's the kicker. It was built from the ashes of the 2008 crisis, echoing the story of the Big Short. Today, we're diving into the private credit market, a system that emerged after the last financial meltdown. We'll uncover how the very regulations meant to protect us have given rise to a new, more dangerous bubble. We'll expose how the world's largest banks are secretly fueling this unregulated machine while pretending their hands are clean. And finally, we'll explore why this looming crisis makes a compelling case for Bitcoin as the ultimate financial refuge. This isn't just about numbers on a screen, it's about a fundamental flaw in our financial system and the escape hatch that was created in response. To grasp the danger we're facing, we need to rewind to how we got here. It all starts with the 2008 financial crisis. After the global economy nearly collapsed, regulators worldwide enacted strict new rules like the Dodd-Frank Act and Basel III. The goal was straightforward: make banks safer. They forced banks to hold more capital, subjected them to rigorous stress tests, and made it much pricier for them to make risky loans. On paper, it worked. The big banks were de-risked. But here's the catch. Risk doesn't just vanish, it shifts. The new rules made it unprofitable for banks to lend to a significant chunk of the economy, especially mid-sized companies that drive growth but are seen as higher risk. So what happened? The banks pulled back, and a new market stepped in to fill the gap. Enter the private credit market. Think of it this way. Instead of going to a bank for a loan, a company now turns to a private fund. These funds aren't banks and aren't bound by the same strict regulations. They gather huge pools of capital from investors like pension funds, insurance funds, and sovereign wealth funds, all eager for higher returns in a low interest rate world. These private credit funds then lend that money out at high interest rates to companies that banks have turned away. This created a boom. Since the crisis, the private credit market has exploded, growing from a niche corner of finance to a massive entity now estimated at nearly $3 trillion. It's expanded 6 times faster than traditional leveraged finance markets. It's become the new, unregulated back alley of Wall Street, where deals can be made quickly, quietly, and away from the watchful eyes of regulators. For a while, it seemed like a win-win. Companies got the capital they needed to grow, and investors enjoyed the high yields they craved. But beneath the surface, the gears of the next crisis were already starting to grind. Now, this is where the story takes a darker turn. The banks never really left the game, they just found a back door. Instead of lending directly to risky companies, they now lend to the private credit funds that do. This practice, known as back leverage, is the secret fuel for this entire shadow system. Here's how it works. A major bank provides a cheap, seemingly safe investment-grade loan to a private credit fund. The fund then takes that money, adds it to its own capital, and lends it out at much higher interest rates to dozens of risky companies. The bank gets to book a safe loan on its balance sheet, raking in steady interest payments, while the private credit fund amplifies its returns using the bank's cheap money. The scale of this is staggering. Major U.S. banks have hundreds of billions of dollars tied up in these private funds. The connections between the regulated banking system and this shadow market are estimated to be a jaw-dropping $4.5 trillion globally. This creates a hidden web of interconnected risk that's completely opaque. Because these are private loans, they aren't publicly traded or priced by the market every day. The funds get to value these assets themselves, a practice some critics call mark to fantasy. Is a loan to a struggling company still worth 100 cents on the dollar? In the private credit world, it is, until it suddenly isn't. And we're starting to see the fallout. After years of almost zero defaults, the cracks are finally showing. With interest rates rising, these highly leveraged companies are buckling under their debt. Default rates are climbing, and some estimates suggest they could hit 5% this year. Morningstar has warned that credit quality is likely to worsen, with more borrowers showing negative cash flow. Fitch Ratings has cautioned that while the risk isn't systemic yet, the opacity of the market could be hiding a serious deterioration in the underlying loans. This is the classic cockroach problem. For every default you see, there are 100 more lurking in the shadows. The issue is that no one knows how bad the infestation really is. Regulators have admitted it's a blind spot. We're flying blind into a storm, with pension funds and insurance companies, the backbone of our retirement system, strapped into a cockpit piloted by unregulated funds that have every incentive to keep the truth hidden until it's too late. If you're finding this analysis valuable and believe understanding these hidden risks is crucial, take a moment to subscribe for more deep dives like this one. We're committed to uncovering the truths that the mainstream financial world would rather keep in the shadows. So, if the system that was supposed to protect us is now laying the groundwork for the next crisis, where do we turn? To find the answer, we need to revisit 2008 one last time. In the immediate aftermath of the banking collapse, while governments were busy bailing out the very institutions that caused the crisis, an anonymous inventor named Satoshi Nakamoto released a white paper. It was titled Bitcoin, a peer-to-peer electronic cash system. It emerged directly from the wreckage of a failed financial system. The very first block of the Bitcoin blockchain, the Genesis block, contained a hidden message, a headline from a newspaper. The Times, 03/01/2009, Chancellor on brink of second bailout for banks. Bitcoin wasn't created to be a get-rich-quick scheme. It was born as a protest. It was a response to a system built on trust that had proven itself untrustworthy. Where traditional finance is layered with debt, opacity, and intermediaries, Bitcoin is grounded in mathematical proof, absolute transparency, and decentralization.
A crucial feature is something our current financial system has forgotten: scarcity. There will only ever be 21 million Bitcoin. No government or central bank can print more to bail out their friends or devalue the savings of their citizens. It's an asset that exists entirely outside the system. When you hold your own Bitcoin, you don't have to trust a bank, a fund, or a government to keep their promises. You just have to trust the code. Critics will point to Bitcoin's volatility, and they're not wrong. In the short term, its price can swing wildly. During moments of market panic, it can even sell off alongside other risk assets as investors scramble for cash. But that volatility is the price of genuine price discovery in a free market. The stability of our traditional system is an illusion, masking the slow-motion debasement of our currency and the buildup of catastrophic risk in hidden corners of the market. Bitcoin is the escape hatch. It's a lifeboat designed for the inevitable moment when the mothership of centralized finance finally hits the iceberg it's been steering toward for decades. Its value isn't just in its potential price appreciation, it's in its independence. It's uncorrelated to the web of leverage and lies spun in the private credit market. When that house of cards comes crashing down, Bitcoin will be the only asset left standing that isn't part of the rubble. The 2008 financial crisis was born from complex, unregulated assets, mortgage-backed securities, hidden in plain sight on the balance sheets of the world's biggest banks. Today, history isn't just rhyming, it's repeating itself. The same dynamic is playing out in the $3 trillion private credit market. A system born from post-crisis regulation has become the source of the next systemic threat, fueled by the very banks it was meant to restrain. The quiet defaults are getting louder, the cracks are turning into fissures, and the regulators who are supposed to be watching are admitting they can't see into the abyss. The question is no longer if this bubble will face a reckoning, but when. And as history has shown us, when the traditional system of trust breaks, a new, trustless one emerges to take its place. That's the story of Bitcoin. It was built for this exact moment. But what do you think? Is private credit the next big short? And is Bitcoin the answer? Let me know your thoughts in the comments below.